Most people aren't losing money in crypto because they're unlucky. They're losing because they don't realize crypto isn't just a market, it's a psychological game. The market isn't just volatile, it's designed to mess with your head. It wants you emotional and making bad decisions. And if you don't understand the game, you're not playing it, you're being played. But once you recognize the traps, you can stop handing your money to the market and start making smarter moves. In this video, I'll break down 7 of the biggest mistakes I see investors making right now, and some that have wrecked portfolios before, with a couple that are more unique to this cycle. Hi, I'm Anna. I'm the founder of Sovereign Stash, where I talk about self-sovereign crypto investing and building financial independence outside the system. If you're serious about not getting wrecked, hit the like and subscribe and let's get into it. Number 7, chasing hype without understanding what you're buying. Now, every cycle, new trends pop up. DeFi, NFTs, AIs, meme coins, and every cycle, people pile in late without knowing what they're actually buying. I get it. When I first got into crypto, I barely understood what anyone was talking about. Every video was packed with jargon, weird protocol names, and technical terms that sounded like a foreign language. In the early days, I also didn't have a research process for choosing my investments. I just bought what people were talking about, assuming if a project kept getting mentioned as a good project, it had to be a solid investment, right? I was really just going on what sounded promising to a total numpty. Sound familiar? And that's how people get wrecked. Lucky for me, I was a micro investor back then and was literally doing $10 trades. So when some trades wrecked me, it wasn't too big of a deal. But these early lessons on really knowing what you're buying taught me that the investors making real money in crypto aren't just chasing trends. They're ahead of them. These people know which projects are likely to have real staying power and which ones are just hype. They can spot red flags before getting rugged. And their research enables them to have conviction in their decisions so they don't panic when the market turns on them. If you don't know what you're holding, you exit liquidity for someone who does. The real winners in crypto aren't lucky. They're committed. They stick around. They put in the hours and never stop learning. They adapt faster than the crowd, which is always waiting to be told what's happening. And they understand this is a long game. If you can push through the noise, through the overwhelming jargon, and actually develop an edge, you won't just survive in this market, you'll be ahead of most. Number 6, predicting a narrative isn't enough. You have to pick the right projects. So crypto moves in narratives. Some people get in early and make serious money, but others buy into the same trend and end up bag holding. Why? Because spotting the right narrative is only half the battle. You also have to pick the right projects. A hot sector doesn't mean every token in it will succeed. Many are cash grabs, weak copycats, or mismanaged startups. Only a few will emerge as real market leaders. Another reason people fail is second-guessing themselves after they've done the research. In 2023, I spent hours researching this AI crypto project that I thought had very interesting and strong fundamentals. But when I mentioned it to my crypto friends, I got silence, no reaction, no validation. That made me doubt myself. So I only invested a small percentage of my portfolio when I was considering much more. That project went on to become a sector leader with a multi-billion-dollar market cap. It was a microcap when I first found it. Had I trusted my research instead of waiting for social validation, I would have made far bigger returns. I really was very early and I just didn't back myself. Never again. If you can guess which project that is, let me know in the comments and I'll reply if you get it right. So how to avoid this mistake? Well, one way is to look for fundamentals beyond the hype. Ask yourself, does this project have an edge compared to others? How unique really is it? Does it have a real product yet? Does it have any real users? And is the revenue growing perhaps? If your research is solid, don't let the lack of external hype shake your conviction. This market rewards independent thinkers. If you can develop your own theses and back them with real research, you'll be ahead of the crowd. Mistake number 5, chasing hype without understanding what stage of hype you're buying. Crypto moves fast. One week it's AI, the next it's meme coins. People FOMO in, thinking they're early, when actually they're late. If your portfolio looks like a crime scene of past narratives bought at the top, congrats, you're officially in crypto. We've all been there. If something drops massively right after you buy it, odds are you are late. So don't be late. Your mother was right. Don't be late, little one. It's the worst thing you can be in crypto. If in doubt, sit it out. Don't chase, replace, or wait for the retrace. I could go on, but I'll stop now. So how do you understand which stage of the hype cycle? If something's being talked about everywhere, on X, in Telegram groups, on YouTube thumbnails and clickbait titles, it's probably already deep in its hype cycle. At that stage, you're not early, you're exit liquidity. Now, if you're still determined to buy, try waiting for the hype to die. Like a lot. Wait until nobody wants it anymore. assuming your thesis is that the market will want it again. So how will you have that kind of conviction? Well, you'll probably need to actually understand what you're investing in, huh? Now, I've definitely made the mistake of buying too late into a hype cycle, getting stuck holding the bag, and then giving up hope. Selling at a loss, only for that same token to skyrocket later when the project had progressed and the narrative returned. One example of this for me that actually ended in a happy ending was Virtual in 2024. That's the token for Virtual's protocol. It was hyped. I bought in somewhere around 13 cents and then it started dumping. And so I panicked and I sold at a loss. It ended up crashing like 90% or something and I thought it was dead. Turns out I was just exiting the bottom of hype cycle 1. Later that year, I happened to notice changes on its price chart. I look at a lot of charts every day, so I may notice things relatively early as they change. The changes on the chart made me take another serious look at what this team was building. So I did more research into the project and I ended up buying back in at 34 cents, more than double my original entry. The team kept building, the narrative came back, and by January 2025, it hit $5. This time I took profits. If I hadn't been paying attention and then done my research homework, I might have missed my chance to be early on hype cycle 2. The lesson is that bad timing and quitting too early are just as defeating as buying the wrong token. Now, the market is second guessing whether it's over for good for AI agent tokens or if another resurgence is coming. Some of these projects will probably come back stronger, in my opinion. Others will fade into nothing from lack of execution or competitors eating their lunch. This is where you want to think like a venture capitalist. Keep researching and looking for signs of teams executing on their plans and place your investments accordingly. Time is money, and you can get paid well for that time invested in your own research. Mistake number 4. Not all information is useful. In fact, most of it isn't. Crypto is an attention-driven market, which means the loudest voices aren't always the smartest. People spend hours consuming influencer tweets and clickbait videos, yet still make bad decisions. Why? Because they mistake engagement for insights. If someone's content constantly hypes price moves or plays on your emotions, they're not educating you. They're influencing you. So follow builders, founders, and analysts, not just influencers farming engagement. Use actual data, market dashboards, on-chain metrics, and developer activity. These matter more than someone's opinion. Prioritize deep dives over hot takes. The best insights aren't in short-form tweets, they're in long-form research. If someone's saying this will 100x, run the other way. The better you get at filtering out noise, the better your decision-making will be. Mistake number 3. Crypto is volatile, but the biggest danger isn't the market volatility, it's you. Emotional trading wrecks portfolios every cycle. FOMO makes people buy high, panic makes them sell the bottom, and recency bias makes them think whatever's happening today will just keep going forever. I've made all these mistakes, and every time it costs me money. That's why I write my sell strategy in advance, not when prices are pumping. I have a document detailing my exit rules for this cycle written in the bear market, because if there's one thing I've learned, it's that whenever my portfolio didn't reach its full potential, it wasn't the market's fault, it was mine. How to avoid this mistake? Check yourself. Before buying or selling, ask, would I do this if the price wasn't moving? Don't forget to zoom out. Short-term moves are just noise. The real trend is in the long-term, bigger picture. Plan ahead. Set targets and rules before the market moves, so emotions don't dictate your decisions. The best investors aren't the smartest, they're the most disciplined. So master your emotions and you'll stop sabotaging your long-term success. Incidentally, I talked more about how to handle emotional losses in my last video called Crypto Wrecked You, How to Rebuild Your Crypto Portfolio. I'll link it in the description. Mistake number 2. A lot of people think holding more coins equals more diversification. But if you're juggling 20, 50, or even 100 plus coins, you're not investing, you're hoarding. If you can't track what you own, you can't manage it. If you can't confidently explain why a token is in your portfolio, it probably shouldn't be there. The more scattered your portfolio, the harder it is to make strategic decisions. Your winners get drowned out by dead weight. I used to think more positions equal more chances to win. In reality, it just made selling harder when the market flipped. Now I have a dynamic portfolio strategy. I expand when a sector's heating up and it justifies more risk. But when conditions shift, I cut back, focusing only on my highest conviction plays. How to fix this? So keep your portfolio lean enough to track. More isn't always better. Have a clear thesis for every token you hold. No thesis, sell it. Invest in a few strong bets instead of spreading yourself too thin. Conviction beats clutter. Your portfolio should be intentional, not a graveyard full of random plays. Mistake number 1, they didn't buy enough Bitcoin. Oof, this might be the biggest mistake of the cycle. Too many people went too heavy on alts and didn't hold enough Bitcoin. Why does this matter more than ever? In past cycles, nearly everything pumped. This time, we have high dispersion. What's dispersion, I hear you ask me? It means money isn't flowing into all alts equally. Only the strongest projects are winning. So why is this? Well, there's actually many reasons, but essentially, as the crypto market matures, investors are less willing to throw money at every project. Institutional players are more selective. We've also got macroeconomic factors such as higher interest rates that make speculative plays less attractive. So we're in conditions that favour real adoption over hype. And as time has progressed, weak copycat projects can be easily seen for their lack of adoption, and only the leaders in each sector are attracting liquidity. It appears Bitcoin remains the king for the foreseeable future under current market conditions. Now remember, I'm not a financial advisor. Always do your own research. This means you can't just be in alts and expect gains. You need to be in the right alts or hold Bitcoin. The truth most people don't want to admit is that greed is holding them back. They still think Bitcoin won't make them rich, and they don't want to admit their altcoin bets were bad. But here's the truth. If you don't seriously upskill, your alts won't make you rich. Sometimes you have to reject the so-called wisdom of degens who tell you Bitcoin won't make you rich. Because let's be real, neither are your bleeding alts. Historically, Bitcoin has made people rich slowly, but only if they didn't sell. So instead of chasing the next altcoin moonshot, doesn't it make sense to keep a solid seat on the one orange train that's actually going somewhere? If you're not confident in picking winning altcoins, you might want to ask yourself, would I do better with more Bitcoin? Not financial advice, obviously. All right, my lovelies, if you made it this far, you're already ahead of most people in this market because you're actually putting in the time to learn. That puts you in a different league, so good job. If this video helped you, hit the like and subscribe. It would mean the world to me, and it really helps me keep making content like this. I know at least one of you is watching this while bag holding something you bought at the top. Confess it in the comments. I won't judge. And if you know someone else who's made some of these 7 mistakes, I dare you to share this with them. Thanks for being here. Keep learning, stay sovereign, and I'll see you in the next one.